What's up, guys? Eric here. I want to bring a quick real talk here, let you know what's going on with the market and what I'm doing with my money. I hope you guys are doing well. So this morning we had PPI data came in hot, 0.4% versus 0.2% expected. Now the 12-month, if you're looking for a positive, was 8.7%. Today was 8.5%. So I guess you could argue that potentially the peak is in, although there's no guarantee that it won't go back and go higher. I've noticed that gas prices have been creeping up again. Went to Costco recently. I noticed that some of the prices were a little bit higher again. We had Pepsi report earnings this morning. What was interesting, if you look under the hood, is they beat on the top and bottom line, and the earnings looked great. But you look under the hood, the growth, there was not really much growth. What's happening there is Pepsi's passing the buck to the consumer. So all the higher labor costs, all the inventory costs, all the production costs, shipping costs, they're passing that on to the consumer. So for an example, if you're buying a bag of chips, they're giving you less chips inside the bag and charging you more for it. And they're passing that on to you. And that's how they're beating inflation. But the problem is not every company can do that. So yesterday was October 11th and we saw new lows on the markets. Right now, the market's very choppy. It's been from positive to red, just kind of chopping around. Market's really waiting for CPI data, which comes out tomorrow morning. So before market open, we're going to get CPI data. We had PPI this morning. Tomorrow, we're going to get CPI data. And if that comes in hot, of course, you're going to probably see the market sell off and probably get some new lows. If it comes in better than expected, you could see a bottom form. You might see a rally. Now, it could be a bear market rally that faded like August. It could fade like it did in August. There's no guarantee it's going to stick. And we really are in a bear market. And it's going to take time to get to the other end of this. So if you're a long-term investor, you're sitting there this week and you keep seeing, you're probably staring at your portfolio, which you shouldn't do. And you see your stocks go down, go down, go down. And you're thinking, what did I get myself into? What am I doing? The best analogy I have, okay, say you're a plumber and you had a plumbing business for 10 years. If times get tough, you're not going to sell your business and then try to buy it back later when times get good again. You're going to have ups and downs. You know, another example, you look at tech. When you look at tech stocks, you look at tech companies, CEOs and publicly traded tech companies have lost $500 billion. That's $500 billion in net worth in 2022. $500 billion. Now, they're probably not panicking and like going and selling their stock. They're thinking about long term and they're trying to build their business. And they're focused on their job and the task at hand. Now, some of the really smart CEOs did sell last year towards the top. But if you look at what they sold, they sold a small percentage of what they own. They still own a lot. So if you're Mark Zuckerberg and you're the CEO of Meta, you saw be on the Forbes, top billionaire list to falling off the top 20 just from the stock price getting hammered as hard as it has. And no matter who you are, there's nowhere to hide in this market. The bond market's having one of the worst markets we've seen in many, many years. There's just no place to hide. Even a 60-40, stock bond portfolio is getting crushed and it's not supposed to. The UK is having all kinds of issues going on with their bonds, and they're starting to do quantitative easing. And the Fed here is just saying, hey, man, we're going to keep raising rates. We're going to keep the pressure on and the pain on until inflation goes lower. They're raising rates to combat inflation, and it's causing a lot of trickle-down effects. It's starting to do some damage. And so we're going to probably see, earnings season started basically this week. We saw Pepsi this morning. On Friday, we're going to have earnings from the banks. And then you're going to start to see some of these tech companies report earnings. And I always say have some cash because, if you look at a list of 20 stocks, there's going to be a handful of those that are going to go down 20%. If they miss earnings, there's going to be some stocks that maybe outperform, that actually go up. And so you have to have a hot list, a watch list. Here's what I want to buy. Here's what stocks I want to buy at what prices. Thinking with the long-term mindset, long-term portfolio. We always talk about building diversified portfolios, having ETFs, dividend stocks, growth spec. If you did that, you had some balance, you held up a lot better than if you're all hyper growth. Your beta does matter. Your beta matters a lot in a bear market. And so the problem I see now is people are selling everything and they're going to ETFs, which they probably shouldn't do. You probably want to buy the ETFs when the market stabilizes. Right now, you want to be handpicking the best, highest conviction stocks that you think give you the best risk reward or the best return over the next 5 or 10 years. You have to have a long-term mindset if you're investing in this market. If you're a trader, you have to be very nimble and get in and out. But if your focus is to buy and hold stocks for 5 and 10 years and to research companies and invest in those companies, then you have to think about where's this company going to be in the next 5 and 10 years. Again, when you own a stock, you own a part of a business. Okay. So the stocks might be broken, but is the business broken? And if the business is broken, has the story changed enough where you need to sell that stock and reposition the capital? Or is it something that they're going to figure out and fix? And you really have to have high conviction in what you own. This is why I like to have a taxable brokerage, because in taxable brokerage, I can have a basket of stocks. And if I'm wrong on some of those stocks, I can tax loss harvest, reposition that capital into higher conviction. I've been doing that throughout this year. And every time I get money, I'm nibbling more stocks. But to give you an example, if I want $10,000 in a stock, I'm buying 10 lots, $1,000 per lot. I'm not going all in. I'm being very strategic. Anything that I own or buy, I do hundreds of hours of due diligence. Make sure you do the same. Don't just listen to a video on YouTube and go buy a stock. Do your homework. People will spend, 50 hours researching a $2,000 refrigerator, and they'll go on TikTok and they'll see a meme stock or a cryptocurrency, and they'll go put $5,000 into it after a 15-second video saying it's going to go to the moon. Think about that for a second. That's what we experienced in 2021. So we had a pandemic. We put a Band-Aid on a bunch of problems, trying to fix it with stimulus. We pumped stimulus in the economy. People weren't working. People got lazy. And then you have lots of trickle-down effects with supply chain. Now people not wanting to go back to work, not being as productive when they're at work, wanting different jobs, wanting more from their employers. You've got labor pressure demands. You've got inflation demands from every aspect, from energy to food costs to transportation. Everything's impacted by oil prices. You get the 10-year treasury at 4%. We've got a lot of problems, and we have to sort through these problems if we want to get to the other side and we want to see positive returns, but it will happen. Wealth is built in bear markets. It's just not realized until the next bull run. And right now is an accumulation phase. So I'm not a financial advisor, and I'm going to give you three tips that I would do if I were you right now. And before I do that, I do need to announce that this video is sponsored by The Motley Fool. And if you want to see the 10 best stocks to buy now, visit fool.com/firedupwealth. So if I were you, here's what I'd be doing right now. Okay. I've been investing for a long time. I'm basically semi-retired. I do this as my full-time job now. I quit my $150,000 base plus commission job to do this, to try to help you be a better investor. I've been investing over 20 years. First thing you need to do, focus on you and your career. Figure out a way to make the most money you possibly can. This is very important. And you can do that with side hustles, but I think it's better to focus on your career, put all your energy into that, find ways to get promotions, whatever it takes. But if you need to do side hustles, just bring in as much money as you possibly can, especially now in a bear market. Second thing you need to do, you need to find a way to save as much money as possible. If you've not created a budget, create a budget, figure out ways to cut expenses, things you don't need, maybe not eating out as much, maybe you don't need as many of those Starbucks pumpkin spice lattes. And you can also do things like negotiate. You can call up your cell phone provider, your cable provider, and say, hey, I'm thinking about switching to a competitor. I need a better price. Times are tough. And maybe they give you $20 off a month or $50 off a month, but you do that 4 or 5 different places, and voila, you've got a couple $100 more that you can invest. And it might not seem like a lot, but it could equate to thousands of dollars a year into your portfolio. The third thing is, of course, you're making as much money as possible, saving as much as you can, cutting expenses. And the third thing is invest as much money as you can in these down markets. And it's really hard to time the bottom. You have to just find stocks that you have high conviction in, try to buy at levels, use that technical analysis. 99% is fundamental. The last 1% using technical analysis to try to get better entry and exit points. And you're really buying stocks that you have high conviction in. So anything you own, go through your portfolio. Do this right now. Go through your portfolio. Look at each stock. Every company, each stock is a company. Look at the company and say, what's my conviction level? Where's this company going to be in 5 to 10 years? And rank each stock on a scale of 1 to 10, 10 being the highest conviction, 1 being the lowest. That's going to help you identify areas where maybe you don't have as much conviction. Now, one thing I will say, the stock price alone should not be the reason why you lack conviction. A stock can be broken. That should not be the reason why you lose conviction and sell it, okay? Do that. And then the second thing you want to do is look at risk-reward returns. So first of all, you need to look at risk-reward returns. Like, what I mean by that is if you go buy mega cap tech right now, you'll probably do okay. But there are some of these IPOs, some of these small cap, these speculative stocks that could give you 3, 4, 5x returns in 3 to 5 years. And I'd be okay with that. That's going to outperform the market. If I buy a basket of 10 of those spec stocks and 3 of them go up 300 to 500%, 3 of them go out of business, and the other 4 just sit there, I'm still grossly outperforming the market with that part of the portfolio. And I'm doing that as a percentage of the portfolio. We talk about having pillars, again, ETF, dividend, growth stocks and spec stocks. So those spec stocks are really interesting right now. These small caps, some of these IPOs that are beat down, some of these SPACs, and some of them go to zero, but try to find those diamonds in the rough. That's what we've been doing. I've been buying some of those over the last several days. I've been nibbling this whole time. I still have some cash. I'm trying to be patient. I've got price targets. I've got a list next to me here that's got all the stocks I want to buy based on my blueprint. Your blueprint's going to be what you're going to use to build your foundation, your house, build your portfolio based on your needs, your risk tolerance, your suitability. And you're going to identify stocks that you have the highest conviction in, that you think you're going to get the best returns. You're going to be nibbling on those and try to diversify. Don't just buy 1 or 2, buy a basket of stocks. Okay. If you lost conviction on a stock, consider, if it's in a taxable brokerage, tax loss harvesting. I have a video on the channel that talks about tax loss harvesting. It can be very powerful because if you're out of cash, it gives you a way to reposition that capital and clean up the portfolio. Now, again, just don't go sell a stock because it's down. But here's one thing to consider. If you bought a stock at $40 and it's now $10, it has to go up 400% just to get back to your cost basis. So keep that in mind. It doesn't mean that should be the reason to sell it, but sometimes you have to admit you're wrong and throw in the towel. Some of these stocks that are down 80%, 90%, you need like 1,000% return just to get back to par. You look at some of these companies like Upstart, like at $20, it was $400. Is it ever going to get back to that? And do you still have conviction in it? And this is why people tax loss harvest. And again, don't just go harvest it based on the stock price, but also, keep that in mind because it's in a consideration. Like, hey, it might take me my whole lifetime to get this money back. I've lost conviction in it anyway. I'm going to move it to something else. So I hope this was helpful, guys. I think that the market's probably going to, if CPI data comes in at par, I think there's a good chance you see some sort of rebound or rally between now and the end of the year. You've got midterm elections. Usually you've got a good run after that. But we have a lot of negative catalysts. We don't have a lot of positive news. We've got Russia, Ukraine. We've got China, trade tensions and semiconductor tensions and this and that. When you look at the S&P 500, the forward PE, what's that number going to be? We're going to see during earnings season, we're going to have to guide down more as the market priced it all in, or do we have to go down another 10% to meet that adjustment on the earnings? And it just depends on what earnings come in at. So right now it's data dependent. We don't know. The first thing it's in our way is CPI tomorrow morning, and then it's going to be earnings season. And you're probably going to see, if not opportunities in the greater indexes, the greater market, you'll definitely see opportunities in individual stocks. And try to find those diamonds in the rough. Have conviction. You have conviction by doing your homework, spending hundreds of hours. Maybe you don't have hundreds of hours, but as much time as possible. Again, people will spend 50 hours of research on a $2,000, whatever, computer or refrigerator, and they don't do their homework on stocks they're buying. It's a big deal because without that conviction, without the due diligence, you don't have the conviction. And when the stock goes lower, you're going to panic sell, fear of losing everything full. You're going to sell. You're buying high and selling low, and you want to be doing the opposite. So I hope this helps. If you're new to the channel, subscribe, click the bell to get notifications. Drop me a comment, guys. Are you guys buying stocks? You think the market's going to go lower? Where do you think the market's going to go? Have you bought anything this week? Are you waiting for tomorrow? Drop me a comment. Let's talk. Let's talk about it. I reply to every single comment unless you're a troll, then I just block you. But drop me a comment, drop me a like. Have a great rest of your day, guys. Take care.